Imagine this. You wake up, markets are down 2%. No warning, no headline that really explains it, just red. By lunch, they bounce back. By evening, another drop. Everyone has a story, none of them agree. It feels random, almost insulting, like the market is flipping a coin with your savings on the table. But here's the uncomfortable truth. Markets don't behave randomly. They behave mechanically, and that's far more unsettling. Because if it were truly random, you could ignore it. But if there's a system underneath the chaos, then the chaos has rules. And those rules are quietly shaping your money right now. This matters more today than it did a decade ago. Not because people got greedier, not because news got louder, but because the structure of markets changed. Most people still imagine the market like a giant voting machine. Millions of humans making rational decisions, slowly pushing prices up or down. That picture is comforting. It's also wrong. Let's rewind. In the early days, markets were slow. Trades were placed by humans. Information moved at human speed. Price changes reflected opinions, earnings, wars, inventions. If something bad happened, prices fell. If something good happened, prices rose. Messy, but intuitive. Then speed arrived. By the 1990s, computers entered trading floors. By the 2000s, algorithms replaced people. By the 2010s, markets were reacting in milliseconds. Today, over 70% of stock trades in the US are executed by machines, not humans. Machines responding to patterns, signals, correlations, not meaning. The market stopped asking, "Is this company valuable?" and started asking, "What usually happens next?" That shift is everything. Because once markets care more about patterns than reality, price movements stop making emotional sense, but they still make mathematical sense. Let's break this down simply. Imagine a room full of people. Each person watches a screen, no one talks. If the price moves up, some must buy. If it moves down, some must sell. But here's the catch. Many of those people aren't reacting to news, they're reacting to each other. One algorithm sees momentum, another sees volatility, another sees a correlation break, another sees a stop loss triggered. A tiny move sets off a chain reaction, not because something changed in the world, but because the system responded to itself. That's not randomness, that's feedback. And feedback systems behave in strange ways. Think of a microphone too close to a speaker. A tiny sound becomes a scream, not because the sound was loud, but because the system amplified itself. Markets do the same thing. This is why a single tweet can move billions of dollars, not because the tweet mattered that much, but because algorithms are trained to react before humans can think. Speed beats understanding. Now let's talk about the math people don't like to mention. Most market models assume something called a normal distribution. In simple terms, they assume extreme events are rare, very rare. But real markets don't behave that way. Crashes happen far more often than the math predicts. 10 sigma events happen every decade, events that should happen once in the lifetime of the universe. That's not bad luck, that's bad assumptions. Markets aren't smooth curves, they're jagged systems with hidden leverage, delayed reactions, and crowded trades. When everyone uses similar models, the system becomes fragile. It looks stable, until it isn't. This is where the illusion of randomness really takes hold. You see sudden drops and think, no one could have predicted this. But that's not true. The timing is unpredictable. The structure is not. Take volatility. When volatility is low, risk looks cheap. So funds increase leverage. They borrow more, they bet bigger. This pushes prices higher and volatility lower, which encourages even more leverage. Everything feels calm until a small shock hits. Then leverage works in reverse. Positions must be unwound. Forced selling begins. Volatility spikes. The same math that pushed prices up now pulls them down. No villain, no conspiracy, just mechanics. The market didn't panic, it followed instructions. This is why narratives fail. After every move, people rush to explain it. They attach meaning to noise. Oil prices fell because of geopolitics. Stocks rose because of optimism. Crypto crashed because of fear. Sometimes that's true. Often it's just a story we tell because silence is uncomfortable. The market doesn't owe us explanations. It doesn't care if the story makes sense. It only cares whether flows continue. And flows are driven by structure. Index funds rebalance on schedules. Options expire on known dates. Risk models update automatically. Huge amounts of money move not because someone made a decision, but because a rule was triggered. That's why markets feel cruelly ironic. Good news causes prices to fall. Bad news causes prices to rise. Because the news itself wasn't the variable that mattered. Positioning was. If everyone already expected good news, prices already reflected it. There was no one left to buy. So the price falls. Not irrational, just uncomfortable. This also explains why individual investors feel constantly late. By the time a story reaches you, the system has already reacted. Not maliciously, just faster than you. Markets today are less like a debate and more like a reflex. And reflexes don't explain themselves. Zoom out further. This structure doesn't just affect prices, it shapes behavior. Companies optimize earnings for algorithms. Governments worry about market reactions more than long-term outcomes. Central banks communicate in carefully engineered ambiguity. Because everyone knows one thing. Markets don't respond to reality. They respond to expectations of expectations. That's a hall of mirrors. And the more complex the system becomes, the more it punishes simple thinking. This is the quiet risk people underestimate. Not a crash tomorrow, not a bubble popping, but a system so optimized for speed and efficiency that it becomes brittle. Small disturbances create oversized reactions. Confidence evaporates faster than it builds. Not because humans changed, but because the plumbing did. So when markets feel random, it's not because they are. It's because you're watching the surface of a system that operates beneath human intuition. Like turbulence on a plane. The air isn't chaotic, you just can't see the structure. The real danger isn't volatility, it's mistaking complexity for chaos. Because chaos suggests helplessness. Structure suggests responsibility. And once you accept that the system follows rules, even strange ones, a harder question appears. If the system isn't random, who is it really optimized for? And what happens when everyone finally realizes the game they're playing isn't the one they thought it was?